Hello, and welcome back to the continuing lecture in corporate finance. I'm sorry, in investment. I saw this is now corporate finance, but Finance 300 investments. In our last class, basically, took a look at the example of allocating our capital or allocating our funds across risky portfolio and risk-free assets, and calculated the Sharpe ratio, and also we have noticed that the regardless of our capital allocation between risk-free and risky assets, our Sharpe ratio will still be the same, and it's basically even when we had even when we had 1.4 weight for the risky assets and -4 for risk-free assets, or whether we have in that case the weight is still total weight is 1. Allocation of regardless of the allocation of the weight, as suppose this is a pretty good example. First, if the weight is 50, right? 15 the risky, 15 the risk-free. The ratio, Sharpe ratio is 0.36, which is 8/3. Because risk 8/22, 8% is the risk premium, right? When you had 15%, right? Return. I mean, 15% return would be the case when you put 100%, y, in other words, y equals 1. You put everything into risky assets, and then because there is 0 in risk-free assets, the portfolio return will be complete portfolio return will be the risk-free risky portfolio return, and then the standard deviation of risky portfolio is also the same thing as complete portfolio, because there is no risk-free assets, right? And when the weight is 50-50, right, you will still see the same. Yes, you will see the same result. So This is actually, this way, you can get confused because it is here, and that's like, let me see if I can move that around. But if it is not movable, this is not the case when, weight is 50. If weight is 50, right? Sharp ratio when weight is 50 will be 4 over 11, which will still give you 0.36. Okay, and when weight is 1.25, then that means what? You short, you borrow at risk-free rate. So 0.25 is the weight. Negative 0.25 is the weight on the risk-free assets, and you put 1.25 weight into the risky portfolio, and then you get the same result. And in that case, complete portfolio standard deviation is 27.5. Complete portfolio return is 70%. Subtract, it will be 10 over, right? 10 over 27.5, still the same thing, right? I don't have to write it again, right? The Sharpe ratio will be still 0.36. And of course, it has to be the same ratio because the Sharpe ratio is nothing but the slope of this straight line, and the slope of the straight line has to be the same thing through and through. And this line is called capital allocation line, capital allocation, right? Because this line basically shows you how your capital is allocated across or between risky portfolio and risk-free portfolio, risk-free assets. Okay, and no matter how it is allocated, will still give you the same. Let me see if I can. Oh no, I cannot move that. No, I cannot move that. So I'll have to do it this. So how do we raise the Sharpe ratio? I mean, think about it. Sharpe ratio is basically a reward to volatility ratio, right? Reward to volatility, which means obviously that's that's like return risk concept, right? Now, unless the Sharpe ratio moves up, right? The productivity or profitability of your portfolio, your complete portfolio, isn't enhanced, right? It's not enhancing. Well, the only way is, if it is possible, I mean, if the slope of the line gets steeper, right, then that would enhance the Sharpe ratio, right? But that's a topic that we are going to discuss in the next chapter, not right now. Capital allocation line, it's a plot of risk-return combination available by varying allocation between risky and risk-free assets. And let's think about that in terms of risk aversion and risk aversion. So why is the the weight that goes into the risky portfolio, right? And we have already defined why this way. I mean, it is only natural because by definition, right? From simply from complete portfolio expected return, we can solve for y, right? So we came to this. Actually, this concept, this formula is ignoring. I mean, it's not. It's purely from the return, but it's not considering the risk, right? So we need to rewrite it. We need to rewrite that equation, right, including the risk. So if we define it, including the risk, basically, that proportion y is basically a risky portfolio's price of risk over investors' price of risk. So in other words, it's defined also, like available risk premium to variance ratio, available risk premium to variance ratio, which is, basically risky portfolio's price risk ratio, right? Risky portfolios price of risk, and then required risk premium to variance ratio, which is required. That's investors, required by the investors. Available, that means a risky portfolio, right? So this is basically risky portfolios A, right? Price of risk, right? But I, rewrote it like this. And then A is the A is actually the same thing, but just complete portfolio, right? So, and in other words, it's defined as risky portfolio's price of risk over investors' price of risk, right? And if you think about it, yes, I also defined it like that. That's the risk premium on. It's the ratio between. It comes out as ratio of risk premium on complete portfolio over risk premium on risky portfolio. And then you might say, aren't they switched in that? Shouldn't this be in the numerator and vice versa? Well, as a result, it's going to become like that. As a result, but for now, you see, think about it. Risk comes not just mainly, solely from the risky portfolio, right? Isn't that right? Risk-free assets don't risk-free assets don't pose any risk. The risk comes solely from risky portfolio, and your complete portfolio consists of risky portfolio and risk-free assets, right? So the think about it, proportion of our risky portfolio, literally, y is the proportion of that goes into proportion of our funds that goes into the risky portfolio, right? So it has to be risky portfolio's price of risk out of investors' complete portfolio, right? Price of, right? And if they are the same, of course, it's going to be 1, right? That means, but then, so let's take a look at this example, which is not a very difficult concept. What would the investor with, price of risk of 3.9 do when faced with market index portfolio with price risk of 2? Our risky portfolio, right? Our risky portfolio has a price risk of 2. Excuse me. And and over, historically, I'm telling you, the market risk, the price of risk for the market traditionally has, not traditionally, historically has been around about 2. I wrote it somewhere, right? I believe I think it was a lot, way before price of risk, right? Somewhere here, yeah, here. Traditional, historically, right? Stock market index, price of risk of the market is 2. Has been, I'm not saying it is always 2. So if that's the case, all you need to do is, just plug it in this formula, right? So 2 over 3.91, then the weight comes to 0.51. So you put 51% in the market index portfolio and 0.49 in the risk-free assets. Suppose this was 4. What if your price of risk was 4? Then it would be exactly 50%, right? 50% into a risky portfolio and 50% into risk-free assets. Yeah, but looking at this formula, let's rewrite it. The formula is basically, risky portfolios price of risk. In other words, in our example, our market, right? And then investors' price of risk. What is investors' price of risk? Investors' price of risk is, complete portfolios price of risk, right? And then is, divided by, so it is 1 over, same thing as, multiplying by 1 over A. A is what? Complete risk portfolios A. Price of risk is, this over this. It is, you're dividing it, so reciprocal. And then variance of portfolio, risky portfolio, and variance of complete portfolio are the same. Isn't that right? Because the risk of the complete portfolio comes mainly, not only mainly, but solely from risky portfolios variance, right? So they cancel out. If they cancel out, finally, what are you left with? You're left with this, which is what? Which is, the result we got from simply, from the expected complete, portfolio's expected return equation, right? Still, we come to the same conclusion either way. Come to the same conclusion either way, right? Makes sense. So this is basically, capital allocation line and what Sharpe ratio means, what Sharpe ratio is and how capital allocation line is constructed from expected risk premium and standard deviation. Now, if you use capital allocation line, right, and capital allocation line of the market portfolio, capital CAL of market portfolios. Yes, market portfolio, right? So CAL of market portfolio is called, market capital market line. Now, in stocks, or not just stocks, but the passive strategy is, basically, investment policy that avoids security analysis, but just allocate the funds according to capital market line. That's a passive strategy. It's also called indexing, neutral diversification approach to avoid costs of acquiring information. So select a diversified portfolio of common stocks that mirrors the corporate sector of the broad economy. So think about it, you exactly mirror S&P 500. I mean, if you have $1 million, you allocate your funds exactly like S&P 500, but it is S&P 500 is weighted average, right? In other words, General Motors or General Electric or these companies would have more weight in this S&P 500 portfolio, right? So you exactly mirror that, replicate that weight, and you have what exactly? You have replicate a S&P 500 market portfolio, right? If you do that, you will earn exactly. You take exactly as much risk as the market. In other words, beta will be 1, and your return will be exactly market return. This is not a very ambitious strategy, but considering the time and effort, if you cannot fully devote your time and energy and efforts to security analysis, right? Then indexing or just allocating your assets according to CML, which is a passive strategy, is not a bad idea. May not earn twice the market. You will earn exactly as much as the market, but your risk won't be twice the market. Your risk will be still just about the same as the market, right? It results in a valuated portfolio with, for example, which invest in proportion in G stock that equals ratio of G's market value to market value of all listed stocks. An investor chooses a portfolio of all the stocks, broad market index, such as S&P 500. I already explained. So actually, you don't have to you don't have to do actually this. You can have, I mean, there are indexed funds, right? Market indexed funds or ETFs. Okay, there are indexed funds. There are two things you can do. Or exchange trade funds, exchange traded funds, ETFs. You can ETFs, right? Which is a basically. So capital market line is a passive strategy using market index portfolio of common stocks as risky asset and 1 month T-bill as risk-free assets. It generates an investment opportunity set represented by CML. So this is basically CML, capital market line, and it looks just like the CAL because CML is CAL of market portfolio, right? And the CML equation is expected return on the complete portfolio is vertical intercept, right, which is RF, right? Because the bottom line, the lowest you can earn, right? If you fail all in the risky portfolio, if you lose it all, but still, risk will earn this. So that's the vertical, that's the starting point, the bottom line. That's the vertical axis. And then if you think about it, this line is an equation in x-axis is what? Standard deviation. So it is an equation in, so this is like y and this is like x. It's an equation in standard deviation of the complete portfolio. And we know what this is. This is the Sharpe ratio. And the Sharpe ratio is what? Sharpe ratio is the slope of Sharpe ratio is the slope of this curve. I mean, of this line, right? Sharpe ratio, right? And the slope is basically, that's the slope, right? Sharpe ratio is, and this is a coincidence, but Sharpe ratio S slope, right? They are both, represented by the symbol S. And in finance, you run into a lot of, these lines, which are very, in a way, very similar in concept, but you will also encounter later, security market line. And it also looks pretty much the same because the vertical axis is, vertical intercept is, risk-free rate. And there's a straight line, but look at the x-axis. And the difference is, here, this is excess return. Here, the vertical axis is basically risk premium, but in security market line, vertical axis is just expected return. Of course, here. Wherever you are here on the vertical axis, you will subtract RF from that. So maybe I don't have to. Okay. Yeah. And the horizontal axis in security market line is beta, right? That's sigma, right? And of course, the CAPM, security market line equation is basically CAPM equation, right? CAPM. So that's basically, the difference between, capital allocation line, capital market line, and security market line. Now, so how good is passive strategy? Cost and benefits of passive investing, right? Passive investing is inexpensive and simple. And the expense ratio of active mutual funds generally averages, 1%. And expense ratio of hedge fund averages 1 to 2% plus 10% of your excess return. I mean, 2% is already, twice the average of the mutual fund fee, right? And then they, again, assess 10% of the excess return. Then is it really, 10%, is it really worth it? I mean, unless they are doing really, extremely superior job, right? If you're, if you put your money with the hedge funds, active management, some money managers can outperform passive strategies. Yes, true. I mean, they are devoting all their time and efforts, so it should, beat passive strategy. But over and over again and repeatedly every time, it's not like that. And then problem is, how do you identify them? And do their fees outstrip their potential, right? So let's take a look at, passive strategy, using, CML, capital market line. 3 periods, right? 3 sub periods, and entire 85 years. Excess return on average was 7.19. Standard deviation was like that, and so Sharpe ratio was 0.4, which is not really that bad. If Sharpe ratio has been between only sub period 3, 56 through 85. That was the lowest, in Sharpe ratio. Otherwise, it was, all above, like 0.3. And 5%, value at risk. And that's something we already have seen. So this is not an inferior choice. It's not such an inferior choice. I mean, hedge funds, are not always, beating this record, right? Alrighty, so that's it for today. time is up. So in our next session, we are going to move on to the next topic, chapter 6. Okay? All righty. I'll see you guys in the next video. Stop